All right, today we've got a real puzzle on our hands, a tech company called RZLV AI. And the big question is this thing a hidden gem just waiting to pop? Or is it a classic value trap waiting to snap shut on investors? Let's get into it.
Okay, so this is where the confusion starts. Just look at the stock's performance. It's been a really rough ride, down almost 30% in the last month alone, and down nearly 33% for the year so far. Ouch. But then, you zoom out and look at the whole past year, and it's actually up over 40%. So what gives? This kind of whiplash is exactly why we have to look under the hood. And that brings us to the big question, right? When the short-term price is tanking, but the long-term trend is up, how do you know what you're looking at? Is it a hidden opportunity or a value trap? Let's break down the tools that the pros use to see past all that surface-level market noise.
So, let's frame this whole thing up. We're going to call this the RZLV AI puzzle. We'll start by just laying out the fundamental pieces that we need to solve.
Our first clue comes from a pretty high-level checkup. Right off the bat, RZLV AI only passes 2 out of 6 key valuation tests. Now that immediately tells us something important. It signals that while there might be some real value hiding here, there are also some pretty serious areas of concern that we absolutely have to investigate.
So let's start digging. For our first major piece of the puzzle, we're going to take a look into the future. We're going to use this really powerful method that tries to project a company's future earnings to figure out what it should actually be worth today.
It's called a discounted cash flow model, or DCF for short. You know, the easiest way to think about it is like this. Imagine you have a tiny little apple tree. A DCF model would try to estimate all the apples that tree is going to produce over its entire life, and then it calculates what that whole future harvest is worth in today's money. It's a really cool way to value a business based purely on its potential. And here's what that DCF model is predicting for RZLV AI. I mean, look at this. Right now, the company is just burning through cash. We're talking more than $70 million in the red because it's investing like crazy in growth. But the analyst's model projects this incredible turnaround. They think it'll start actually making money by 2026, and a decade from now, it could be generating over $250 million. That's the optimistic future this whole model is built on.
So, what's the bottom line? Well, when you take all that future cash it's supposed to make and you calculate what that's worth today, the model comes to a pretty shocking conclusion. Based on this one analysis, the stock looks like it could be almost 70% undervalued. That's a huge potential upside. Okay, now for our second clue, let's look at what the books say. So instead of trying to predict the future, this method just looks at the company's value right now, based on its official balance sheet. And this slide really shows you the problem in black and white. We're looking at something called the price-to-book ratio. It compares the market price to its net assets. Now, its competitors, they all have a positive ratio, but RZLV AI, its ratio is deeply, deeply negative. What that means is, on paper, its liabilities are actually greater than its assets, and that is a major, major red flag for any investor. But hang on, a simple price-to-book ratio isn't always the whole story, right? Especially when you're talking about a high-growth tech company. That's why analysts use a more tailored model, something they call a fair ratio. Instead of just comparing RZLV AI to the average Joe, this model creates a custom benchmark just for them, factoring in things like their higher expected growth and unique risks. And here is where the mystery really deepens. Because even when you use this more nuanced, fair ratio lens, you get the same conclusion. The stock still screens as undervalued. So now we have 2 totally different clues, both pointing towards the stock being a bargain, despite that giant red flag on its balance sheet. How is that possible?
So, what do? We've got 2 models saying it's undervalued, but a balance sheet that looks pretty scary. How do we solve this? Well, this is where we get to the final and honestly, the most crucial part of the analysis. It's where you have to write your own story. See, the ultimate tool here isn't another rigid calculation. It's something called a narrative, and it's exactly what it sounds like. You build a story for the company. You get to decide what you believe about its future growth, its profits, and all the risks it faces.
This approach really puts you in the driver's seat. You don't just accept the numbers, you build on them. First, you write out your story. What do you believe is going to happen? Then, you link that story to the financial forecast. Third, you see what fair value your story creates. And finally, you compare your number to the market price. It lets you test out any scenario you can think of.
And the key takeaway here, why this matters so much, is that this is what empowers you. It takes you past static numbers and shows you how different believable stories can lead to totally different valuations. It connects your personal view directly to a number, and it puts you firmly in control of the analysis.
And so, we end right here, turning the final question back to you. You've seen the conflicting data, you've got the tools, and you understand the power of building a narrative. So is RZLV AI a rocket ship that's about to take off, making that risky balance sheet totally irrelevant? Or is it a trap, built on a story that's just a little too good to be true? The story you write is the answer you're looking for.